For Morningstar, I'm Christian Charret. Here at Morningstar, we've often said that our star rating is a good starting point for investors looking to pick funds, but it shouldn't be the only criteria. My guest today would agree, at least with the second part of that statement. Fran is a principal at Vanguard's investment strategy group, and this past summer he wrote an article warning investors about taking shortcuts with their fund picking this way. Mr. Kinniry, thank you very much for being here today.
Thank you, Christian.
Now, Vanguard did some research in the United States on the performance of funds after they've obtained Morningstar's highest ratings of 4 or 5 stars. What did that research reveal?
So the research revealed, if looking at the star rating, it's really looking at past performance, and so it doesn't necessarily translate to forward performance. So as you mentioned in your introduction, using the star rating as your only criteria or a shortcut criteria could lead investors down the wrong path.
And to what extent does the performance tend to deviate after the funds get the high rating?
Yeah, and I would not leave it just at Morningstar star rating. So performance ratings in general, whether it's any rating service, the blog that you're mentioning of what I wrote, it really looked at how in many other areas of life, such as a restaurant star rating or a hotel rating or consumer reports, there's a lot of persistence in durability, meaning if something did well in the past, tended to do well in the future. But in the investment markets, whether it's a fund or even an asset class, let's say emerging markets versus developed markets, we see a more cyclical pattern. So relying on the past in investments is not the best guide as it is in many other areas of life.
And how do you explain this inconsistency in performance?
Well, the markets are cyclical, and so in a relative rating, like the star rating, you're looking at, let's say, all funds in a category, and you're ranking them relative to themselves. And so they could have just been in a different part of a market that is the same. Let's say large cap value investing, for example. The fund that may have done the best may have been deep value, and deep value may have been in favor over that period, but then it may switch the market to relative value. And so that fund that was in the top could easily go to the bottom, and we see a very lack of persistence in the capital markets.
And what should investors do? Should they simply ignore past performance?
Yeah, so I think the analyst rating that Morningstar does and others show that costs is really the #1 predictor of future returns. So if you use costs as a good measure of future performance, that would be a great starting point. That is the most persistent way to think about which funds will do their best. Beyond that, you would think about the areas you can control, your asset allocation, your sub-asset allocation, your diversification, your home bias. We do see in Canada investors with a lot of home bias, concentration in a few sectors like financial sector or the energy sector. And so being more diversified and lowering costs would be a great way to develop a portfolio.
And your article also contained a warning against performance chasing by investors.
Yeah, so I think it's within the article itself, what we have seen is it's intuition, and it's only natural to think about buying something that has worked well in the past. And so I have empathy with investors. I'm not critical of investors, which a lot of the behavioral research is quite critical. It's hard to think about getting an investor to go buy a fund that has, or even an asset class that's in the bottom. And so we see investors continually buying the asset class or the funds that have done well over the last 3, 5, and 10 years. They repeat that cycle over and over again, and then they're disappointed. So back to the basics of developing a portfolio. Rebalancing would mean you're selling your winners and buying your losers, which is the opposite of what we see in cash flow data.
Mr. Kinniry, thank you very much for explaining all this to us today.
Thank you, Christian. Appreciate it.
And for Morningstar, I'm Christian Charret. Thank you for watching.